Today, we're going to analyze automatic data processing, ADP. They do HR and like payroll services for tons of different companies, and they are currently a $100 billion company, absolutely massive company. They do a lot of payments processing, basically, kind of like Visa, actually, but more for workers. And the 5-year chart looks pretty solid, 50% return with a 2% dividend. It has underperformed the S&P 500, but uh, the consistency of this business is really, really amazing. So the 5-year chart is 50%, the all-time chart. This is the type of chart that I love to see, and just insane returns on the all-time chart. And really, in the past 10 years, you could just see the parabolic growth. Let's take a closer look at this company's financials, and you'll see just how consistent this company is. And you see positive revenue growth every single year, and positive about 6% a year going to 2023, or at least on average compounded, it's like 7%. And then it translates so well into their net income. The gross margins are super high, and then they have to pay their workers, and their operating incomes are really high, and their margins have actually been expanding as well. So their net income growth has been growing faster than their revenue growth. Taking a look at their balance sheet is pretty solid as well. They only have 1.77 billion in net debt, so not bad there. Cash flow, what are they doing with their cash? Well, they're doing a little bit of buybacks, and then they're also paying a dividend. So they bought back 1 billion of stock last year, and they paid almost 2 billion in dividends. And they're also paying down a little bit of debt. So really, really consistent company. That's what I like about this one. And yeah, the margins here, their ROIC is actually super high. You love to see that for ROIC. And then gross margin has been expanding. Their net margin has been expanding as well, up to like that 19% mark. Let's take a look at the analyst estimates here. They're estimating 9 going up to 10, and revenue going from 19 billion up to 20 billion, which is basically a 6% increase, and then the next year another 6% increase in revenue. In terms of their short percentage, they are only 1% short, so that is a green flag. Not too many people are shorting. Yeah, I think this company is like super, super easy to analyze, so we can just go straight to the DCF model. This company, we're just going to project what they've been doing in the past into the future because they're so consistent that I think it's obvious that this is what's going to happen. And so what we have is earnings growth. Well, okay, I put the estimates here from the analyst, and buybacks of 1 billion. That's what they did last year. Net debt 1.7 billion. Discount rate to 10% because I want the 10% return. Also, this company has a massive runway for growth. They can grow pretty much indefinitely into the future as more and more countries and more people become digital and accept digital payments. We're going to use this company. So that's why I have them as an exit multiple of 25. They currently trade at 28. So 25 is a bit steep. I admit it. Maybe we'll try 20 later. But in terms of earnings growth, I just have them growing at 7% every single year from here until 2030. And in this case, they're overpriced, but not by much, just by a little bit. And same with the revenue one. They're estimating revenue growth of 6%, and I just project that straight into the future. That's what they've done in the past. Actually, they did 7% the last 6 years. So I'm projecting a little bit less into the next 6 years. And then profit margin has been expanding as well. So if you just project their profit margin by expanding 0.5% every single year, then you get up to 22% margins. And in this case, we're looking pretty close to fair value on the stock. It's very close at like just 2% overvalued. So I think most dips in this stock are probably going to get bought up just because of the consistency. But also, we could try adjusting these numbers to like maybe the worst case scenario. Now, the worst case scenario is you'd be accepting a 20 exit multiple, and our profit margin stayed steady at 20%. I feel like this is the absolute worst case scenario on this company. And then you'd be looking at a fair share price of about $190 a share. And you'd probably be expecting like a 7% return. Oh, that's 70, my bad. 7? Maybe a 6% return. Yeah, I think in the very worst case scenario, you'd be looking at a 6% return over time with this company. And in a better case scenario, you're looking at like a 10% return. So yeah, it's a really solid company. You could add it to your portfolio as like a core holding, because of the low volatility, and you're probably not going to lose money in this stock. I really don't see it ever like dipping massively. So yeah, something that I would add to my portfolio, but I do think that there are other stocks that have better growth potential than this. So I currently do not own this, but yeah, I might add it at some point in the future. But yeah, that's the analysis. I hope you guys enjoyed. If you did, hit that like button and feel free to debate me in the comments. I'll see you in the next video.